Joining me on the line to discuss the aftermath of the Federal Reserve policy meeting is Mike Jakeman, economist at the EIU in London. Mike, the Federal Reserve left rates unchanged at 0.25% yesterday. How have markets reacted and what impact has this had on the euro-dollar?
The sort of long-run effects of the FOMC meetings we've seen recently and the ones that we expect to continue to see in the next few months are all going to be positive for the long-run strength of the dollar, which will appreciate against the euro. So far this year, we've seen very little dollar appreciation. That's because Europe has actually grown a bit faster than we were expecting, and the US had that terrible first quarter. However, the sort of short-term prospects are much better for the US. We think the underlying fundamentals of the US economy are still pretty strong. So as a result of what I think was a relatively positive meeting for future interest rate rises, we'll start to see the dollar appreciate again imminently. And certainly it will continue to strengthen once the US begins to raise rates.
Now, could you explain the main issues addressed at the meeting and what the Fed is looking for as indicators to raise rates later this year?
So the Fed acknowledged yesterday that the economy is growing pretty well despite that first quarter. The job growth has picked up, household spending is reasonably good, and the housing sector has improved too. The things it's going to be looking for in particular when it makes a decision about when to raise interest rates are inflation and the job market. Now, as the year ends, we're going to see inflation pick up. That's mostly because that will be a year since oil prices fell, which means that will kind of disappear out of the comparison. And secondly, the job market has done so well in the past year. We've seen 13 months in a row of new job creation of 200,000 a month, which is a very strong rate. And that means that the unemployment rate is now almost down to the kind of structural level that the Fed believes is the sort of lowest it will go, which is about 5%. And those two things together will mean that we expect to see a rate rise coming pretty soon.
Now, there's 4 meetings remaining in 2015, and some analysts believe that we could see 2 rate hikes. What are your thoughts on this?
As a result of the meeting yesterday, the Fed said that it expected the Fed funds rate to be at about 0.6 by the end of the year, which would imply 2 rate rises, as you said. We're pretty confident that we're going to see the first rise in September, which would then give it a couple of meetings pause before perhaps it raised again in December. The sort of wider point to note from this is that when it does raise rates, it's going to be slow. It's going to be quite predictable, I think, because there's still a lot of debt in the US. They don't want to frighten mortgage holders. We're certainly not going to see anything like the sort of 15 consecutive rate rises that we saw during the beginning of the last tightening cycle before the global financial crisis.
Thank you, Mike, for your insight. Well, that is all for now, but keep clicking back for fresh updates. Goodbye for now.